Recent economic data shows that the risk of stagflation in the US is rising. The CPI report recently showed that inflation is much higher than most people expected. The GDP forecast is going to be negative, at least that's the forecast for today, and gold prices has never been as high as they are today. Last time the United States experienced something like that was 50 years ago, and it took the United States almost 10 years to get out of the crisis. Back in 1970s, the United States had the exact same problem. Oil shock prices, government spending is getting out of control, and unemployment is really high. But today, those problems are 10 times worse. So if the United States is actually going to get into a stagflation, the consequences could be way worse than anybody could possibly expect. Because back then, we did not have a rising China whose economy is almost as big as the US economy that can swipe in and move the United States to the second place. So let's find out what are the chances of the United States actually getting a stagflation and how that is going to impact you. So if you're ready, give this video a thumbs up and let's dive in. Stagflation is one of the worst things that could possibly happen to any economy. That's when prices are increasing within the entire economy and you look at the numbers, it seems like everything is growing, but the real economy isn't growing at all. You are making more money, but you can't buy much with it. Why? Because inflation is rising. And that inflation is what leading the economy to grow and not the real growth and not the real productivity. And back in 1980s, inflation hit a record of almost 14%. So if you think 3% is high, 14% is way worse than that. And that didn't happen overnight because it started back in it started back in the late 1960s, and in 1970s it peaked. After that, even though that there were multiple attempts to bring down stagflation or the inflation in the US, it was unsuccessful. By 1980s, it reached an all-time record when the Federal Reserve increased the interest rates to 20% in order to cool down inflation. The economy was actually growing on paper, but the real economy, the real wages of people who are working wasn't growing at all. It was actually going down. And one of the main fundamental reasons behind this situation was the fact that oil prices got out of control. You see, the United States has never been a net exporter of oil that it's today. But even today, when it's exporting so much oil, it's still relying on Canada for most of its oil. But the situation back in 1970s and 80s was way worse. The United States mostly imported its oil from Middle East. Due to the United States foreign policy, those Middle Eastern countries decided to put an embargo on the United States. They simply said that we're no longer going to sell our oil to the US. Suddenly, oil prices jumped to $140 adjusted to inflation. At this price, it was simply too high for people to buy oil, and it wasn't even available. You would simply go to a gas station and there is no oil. So when you have such a high oil prices, that impacts everything within the entire economy. But that was just part of the reason, because the second reason was expansionary monetary policy. And that's just a fancy word for saying that the government suddenly decided that we no longer care about inflation. If you go back to 1950s and 1960s, interest rates were at the lowest possible. It was like around 2.5%, maybe 3% at best. Even if you compare those interest rates to today, that's absolutely nothing, because even today, like, interest rates are like, what, 4.75% to 5%, something between that. Back in 1950s and 60s, the economy was completely different. Remember, back in the days, the US dollar was backed by gold. But because the United States had one of the biggest wars in its entire history, which was the Vietnam War, and that was the main reason behind the expansionary policy of the US. On one side, you're lowering interest rates. On the other side, you're borrowing so much money, and that's throwing so much money into the economy, making the real value of the dollar so invaluable that inflation starts rising. And when you have inflation, what do the companies do? They will start passing down that money down to the consumers, and that raises the prices of everything, and the people are going to demand higher wages because those previous wages no longer satisfies them. Those previous wages no longer gives them the kind of life that they had in the past. Of course, they won't actually increase their wages as much as inflation, but you have to increase it slightly. And that's why if you look at the gold prices, you can clearly see that there was a huge spike. Now, obviously, back in 1971, Nixon took the United States out of the gold standard. Even though that there was a spike in gold prices in the beginning, they jumped back. But after that, because it got out of control, the gold prices rose 10 times from around $2,000 back in 1970s to as much as like $22,000 or $23,000. If the economy is growing, if the output is growing, if the real productivity of the people are growing, then investors are more likely to invest in that productivity, because that productivity creates real value and prices of those assets rise much faster than the gold. The only reason that you have gold prices rising substantially is because investors no longer simply believe in that output. They no longer believe in the economy growing so much. Let's compare those statistics to today and see what is the situation today. Now, first of all, if you look at inflation, of course, inflation today is nothing close to what we had back in 2022 when it got out of control. The numbers that you see on the screen, which is like 3%, isn't actually as accurate. Since 1970s, they have changed the CPI report in such a way where they're trying to underestimate inflation as much as possible. So they took out the house prices, they took out asset prices, they took out other things from that CPI report. The CPI report, this Consumer Price Index, is one of the major indexes that the Federal Reserve uses in order to estimate the economy, to estimate the inflation within the economy. And another interesting thing they did with the CPI report is that they realized that when prices increase, consumers simply switch to cheaper alternative because they no longer have the money to buy those things that you used to buy in the past. And CPI adjusts its, and they kick out those expensive things out of the CPI report, and suddenly your inflation data isn't as high as it's supposed to be. If the Apple is going to increase the price of the latest iPhone by, let's say, 100%, and most people stop buying that latest iPhone and they will switch to a cheaper iPhone, the CPI report will simply kick out the latest iPhone out of the category and it won't consider it as part of inflation, which is literally a direct manipulation in order to bring down inflation. So this 3% that you see is already is not accurate. First of all, it should be much higher than that. But even with all of the manipulation that they are doing, they still can't bring down inflation to less than 3%. That's why if you look at the long-term view of experts about what's going to happen to the inflation, is higher than it was in the last 30 years. Far now, we might not experience that massive inflation, but remember, these are the policies that the US actually took, and their consequences wouldn't be immediate, because the Fed can instantly raise interest rates, and for a brief period of time we might bring down inflation, but it doesn't mean that it's going to be disappeared. It doesn't mean that inflation is going to disappear and there won't be inflation. Because if you look at the monetary policy today, it's way worse than it was during the time of Vietnam. Just like in 1970s, the United States is experiencing oil shocks. Now, the first oil shock was back in 2022 when there was a conflict in Europe, and that brought oil prices to as much as $120. But they didn't last long over there. Since then, they have come down to anything between $70 to $80. But there is a huge problem. Trump is imposing tariffs on Canada, which imports 52% of all the oil that is being used in the United States. So if you are going to impose tariffs on that oil, suddenly oil prices are going to rise from at least $72, maybe, I don't know, like $90 to $100, maybe more than that. These are just the lowest expectations that I'm making. Worst case scenario, they can literally go to anything around $100. And if the US decides, on the other hand, that it won't be actually paying so much for the Canadian oil, maybe Canada is going to raise prices for the United States in order to balance the budget. Remember what Trump said, that Canada is not buying as much from the United States as they're supposed to do so. So Canada right now, or has been for a very long time, selling its oil to the United States at a huge discount. They can literally increase that oil prices in order to balance the budget between the United States and Canada. And that means that increase from the Canadian side, an extra 25% tariff from the United States, and that will totally bring the oil prices to around $130 to $140, just like it was back in 1970s, which is, to be honest, is insane. That will drive the prices of everything. Now, I don't know how long that is going to last, but there is a real possibility of that actually happening in the foreseeable future. And we're not talking about like a year, 2, 3 years from now. That could literally happen this year if they don't sort it out. And if you look at the expansionary policy of the United States recently, it's way worse than anybody could possibly imagine. United States enjoyed expansionary monetary policy for a very long Donald Trump. But there is something fundamentally I do not understand. But the question is that why it's not going back to the pre-pandemic level? Why it's still increasing year by year? These are the expectations that it's going to go to $1.6 trillion by the next couple of years. But last year it was like $1.9 trillion. I mean, ask yourself, why are we having such a huge expansionary policy within the US economy when we are not in a pandemic? Like, the expansionary policy is pretty close to the expansionary policy that was during the pandemic. So it makes no sense whatsoever. Even if you look at the total spending, yes, there was a slight decrease in the spending, but not much. And if you look at all the expectations, spending is going to skyrocket over the next couple of years. And if you look at the budget for the last year, the payments for the interest rates alone has increased up to $1 trillion. It was probably like $1.1 trillion. So the expansionary policy today is way worse than it was back in 1970s. And the problem, or the difference between today and the 1970s, is that in 1970s, at least we had the opportunity to actually fix the problem. Today, we do not have that opportunity. President Trump is going to be the last president in the history of the United States that will attempt to fix this problem. Because if he will be unsuccessful in fixing this problem, and chances that he will fail are extremely high, to be honest. Again, I'm not trash talking Trump, I'm just talking that the problem is so big that Trump probably won't be able to fix it, even though that he has some really great people around him, such as Elon Musk. But I don't know, we're gonna wait and see. But if he won't be able to fix this problem, it's over for the United States, and this expansionary policy is going to move forward, and the inflationary period won't actually stop. So to what extent it's going to get bad? Will it turn into a stagflation? Well, there is a real possibility. And that's why if you look at gold prices, they're rising faster than they have even been back in 1970s. And that's why everybody is expecting a stagflation. If investors weren't actually expecting stagflation, and we're talking about investors, we're talking about huge financial institutions, we're talking about BlackRock, we're talking about the Vanguard, we're talking about even countries that invest in the future, we're talking about people with trillions of dollars. If those people weren't actually expecting such a stagflation in the foreseeable future, they wouldn't be actually dumping all of their money buying gold, driving its prices to the all-time high. Gold prices has never been as high as they are today, and the only reason that they are growing so much is because there is so much demand from investors. Whenever there is stagflation, remember, the first thing that happens, asset prices rise, because prices of everything rise while the real output of the economy goes down. And that's why if you look at the forecast of the US economy, the GDP is expected to plunge to negative 1.5%. It's literally the definition of stagflation. Inflation is rising, but it's not growing the economy. Now, the only difference between today and 1970s is that we don't have unemployment problem. Unemployment today is around 5%. Maybe slightly more than that, or maybe slightly lower than that, but it's around 5%. That is fundamentally different from the peak of 1982 when unemployment grew to almost 11%. But we might actually experience unemployment in the coming future when economy won't actually be growing as fast as people expected. Because if you just go back, for example, to early or the late 1970s, unemployment was actually pretty low. And suddenly when everything got out of control and companies realized that they have actually to be more rational with their spending, the unemployment started rising dramatically high. So the moment that you see that unemployment is going to rise in the US, then probably, or the probability of stagflation goes like to 100%. And the first thing that happens in those circumstances, as I've told you earlier, and it happens every single time when there is any kind of inflation within the economy, asset prices rise, house prices rise, stock prices rise, gold prices rise. So the best way to protect yourself is, again, just like all these investors are doing, is to invest your money in the right assets. And one of the best places to invest your money is obviously the stock market. And if you're new to the stock market or you want to become a really great investor, then check out the link in the description. That's it for today, guys. Thanks for watching, and I will see you in the next one.